Good weekend, all. Ira Epstein of Linn Associates with your weekend edition of your agriculture update. And this is for Friday, the 5th of April, 2019. Now, we still have about 10 minutes left of trading in the stock indices, the metals, the currencies, and the bond treasury markets. But the ag markets have already closed. The event of the weekend is a bit of disappointment because we did see that President Trump this week said that it could take another month if they can do a deal. He keeps always saying that. That's the pressure on the Chinese, that if a deal can get done, it probably is another month, and it even could take 2 weeks after the deal is done before they get the final writing and then the summit is called. You know, we were all led to believe at the beginning of the week they were getting ready to call a summit. Sounds like a deal was done. Well, it's not, but we don't know what the truth is. Always remember that. They're keeping it hidden from you to a large degree. The good news is that the Chinese delegation that was supposedly going to leave today, these are their head negotiators, have decided to stay through the weekend. That's a great sign. It means progress is being made. If no progress was being made, they go home. Whenever you got momentum, you don't leave the bargaining table. But you were down, as you can see today, in the grains. And if you're looking at the monthly area chart of just closing prices, you're still staying under this 929.5 zone, which gives the market, while it's had a bounce, still an overall bearish bias. When I look at the charts here, the high of 1071 back to 810.5. This is a weekly chart, so it's very relevant. What you did is you have what we call a bounce in the market, and I kept saying, and I have been saying, that the market has stalled out against the 38% retracement. It's a Fibonacci number, and it's just sort of hung there. It's not going anywhere. It's just hanging on this bottom line. This would be the 50% line, the 940 area. When we take a look at weekly charts, there's a couple of things going on. Certainly, the legacy has been lower highs and lower lows up until last week. Last week, we did not break through a previous low, and this week we have what's called an inside week. We did not take out last week's low. So the reality is you have lower highs and higher lows. The market is narrowing in like this on you. Where's it doing it? Look at the 18-week moving average of closes. If you go back and you do your analysis, you'll find that this moving average, when prices go sideways against it, there's a reason. The market has got a certain amount of bulls, bears on either side, and this neutral zone, that's what I call it, a DMZ zone, think of it that way, is that number, that 18-week moving average, and the market's trying to figure out what to do. Now let me give you, as a technician, what I see. Take out 912 and you suddenly have higher lows and a higher high. Don't take out 912 and take out instead 883. You've got lower highs and lower lows. We're starting to narrow into some numbers that are making sense. The problem on the downside is to get through 883, you're right into the bottom support, and on the 912 area, you're looking for a little more room to the upside into that longer term average, also that 928, 940 area. They both come back into play there. Visually, you can see how you're just caught in the sideways action of the Bollinger Bands. The black lines are an algorithm designed to keep the market trading within them 95% of the time. When you hit the 18-week average, think of this like a pinball game. If you go up, the flipper's waiting for you to beat it back down. Drop to it, the flipper's going to try to flip up and flip the price. That's another way to look at it. As we look at momentum, it's pointing down. So I have a market that I could say has, because of the close, under the 18-week average, some downside bias, momentum down, but I'm saying it's not in a trend. It's churning sideways. When I take a look at meal, we had two failed attempts in this market. Let's take this one. The market tried to break out to the downside. You see right here. And as that happened, you came snapping back and momentum changed on you as well. From there, and this was March 15th, so I don't want to give you the impression this is history. This is a weekly chart. The resistance could be the upper Bollinger Band, didn't quite hit it. Then you make your move on the 29th. Remember, today's the 5th. to make a move there. You get up, and all of a sudden you collapse back, and this week you just stalled out again. Do we have a trend? Absolutely not on a weekly chart. You got a lower low, a higher high, caught in sideways action. Not trending, but very important. This all becomes either a top or a base of significance over time. When I go back to the bean chart, this too. Whenever you get the narrowing of Bollinger Bands, daily charts, weekly, out of this comes something big. So you don't want to turn your back on it and say, I'll look at it in a month or so. You're going to, no. In the soybean oil, you had a correction that ran out of momentum right here and went back to this let's call it the 18-week moving average of closes and stalled out. We saw that on the daily charts too. When the daily momentum was embedded, it lost and it went back to the 18-day average, similar to what we're doing here. Excuse me. In the corn market, like the soybeans, you've got lower highs, but now you've got higher lows. And notice how these thrusts down to the lower Bollinger Bands have been unable to propel the market anywhere. This isn't as good a looking chart for the longer pull because it's not as narrow as the meal or the soybean chart. I think you can see that. I don't see what to do with it, all because to get the trend down, you got to get under 356 the way that I define it, and then you'd be under the Bollinger Band. Staying under that, you only do it 5% of the time. So there's no edge in that I see, and I'm always looking to see, is there an edge in a trade? In the wheat market, the 100-week average has suddenly become important. The market got up to this last week. It's trying again right here. Now, if this market can clear the 478 level, I believe that's the number here, 478, you would develop a pattern of higher lows, higher highs. That would negate the downtrend that is in play. Lower highs and certainly lower lows. So we have a defining number at least there, and the chart would have to rebuild. It'd still be under the resistance of 495, but maybe that's where the market could get to. But the fact that it's under the 18-week average keeps one of my filters away from being a buyer. Getting out of shorts is a lot different on longer-term charts than getting long. The cocoa market's turned into a son of a gun. It went from this big spike low and changed dramatically. Now you're back at a Bollinger Band high. You know what I'm going to tell you? Generally, the first challenge of a Bollinger Band is where you run into the problems of the resistance. The momentum is up, the bias is up. I'd be looking to see if the market on breaks has support between, and I expect to see it, 22.62 down to 21.97. In the sugar market, you have an outside week up, and that's important. Now what I say is I throw, just as my rule of thumb, higher lows now, lower highs, like the beans in the meal market caught in this narrow band. I don't see a market that's following through one way or the other. Chop City, not chop suey. And by the way, it's one of my favorite foods. Chop City. In the coffee market, momentum is still locked into the downside. You had an outside week down. You'd have to take out this week's high, I think, to scare the bears. You can do it either this coming week or next week. That's in play for 2 weeks. But as you get to lower Bollinger Bands, what do you think I'm going to say? I'm going to say I think the pros are covering shorts down there. In the cotton market, I thought the market would have more resistance at the 100-week moving average of closes than it is. This market's trying to leap to the upside all on itself here. Could this be the market starting to say maybe China, maybe good things, maybe they'll be buying? I don't know. But the market's certainly in an uptrend. In its first resistance, the next level of resistance is 80.03. Even if it breaks back on this chart, I'd be looking for support at 74.5. In the cattle market, this is a corrective move down to support at the 100-day moving average of closes. The market has stepped out of a trend. You have a higher high, lower low, momentum pointing down. And in the hog market, China. They have been buying pork. They didn't, from what I saw this week, buy any this week, but the market's anticipating they have to buy more. A thin market is how I view it. The market has now got... let's see, this week we closed at 79.02 over the Bollinger top, over the Bollinger top, over it. Even on weekly charts, you rarely do 5 in a row. So I think you're getting a little rich in price is what I'd be saying. I want to remind you about one of our favorite things that we get the most calls on because people like to learn about technical indicators. And our good friends at Futures Magazine had put this together. I helped them resurrect it. The business of their business is not publishing right now, but I've still got these. And I just had the editor, in fact, in the office last Friday we were talking. But to make a long story short, I think these are phenomenal. They're easy to read. Each of the booklets, 20 some odd pages long, and we'll send them to you as a PDF. You can print them out, you can look at them on your screen, but it gives you all these different things in a way you can understand it. And that's the hardest thing for people beginning in the charting world. How do you get it? It's free. Just go to our website. You'll see a carousel of free offers. Click on it. Look for the Guide to Technical Indicators. We'll get it emailed right out to you. I'm Ira Epstein. Have a great weekend. Talk to you on Monday.